Good afternoon. I'll just wait a moment for people to join. I'm going to begin. How are you doing all? Obviously very difficult times. Just to explain, if you're not already clients and you've joined us, nice to meet you. We are Oury Clark. We are lawyers and accountants based in the southeast of England. About 130 of us, a couple of offices, and we just started this series. It's going to be weekly. We'll update it weekly just to try and deal with everything going on. My name's Andrew Oury. I'm a chartered accountant and chartered tax advisor. I'm joined by Simon Walsh from our commercial team.
Hey, everyone.
Ross Meadows who heads up employment law.
Hi, everyone.
And Hugh Williams, a fellow accountant like me.
Hello, everyone.
We're going to do questions at the end. If you've got questions you want to ask, there's a Q&A button you should be able to please put your questions in there and we'll try and go through them all. So off we go. He says, hang on. Okay. So this is 7 practical steps just to try and mitigate this madness that's going on. Yeah, if there's anything you want us to add as the weeks go on, do let us know and we'll try and research it and be able to tell you about it. Things have come up even from the webinar we did this morning till this afternoon. First thing to say, it's obvious, but seriously, it's worth saying, don't panic. But you do need to take action. We all need a little bit of luck. So hence 7 things. First thing is clearly probably the most important, cash. I think we may be talking, certainly in Germany, they're talking about 12 months. Some people are saying 3 months. Some people even saying 18 months. But this is really a liquidity problem for businesses. And the first thing you need to do, if you haven't already, is get a cash flow together and cut everything you can in terms of not, looking at your fixed costs, looking at your various debtors that you may be able to work with and try and come up with a plan of how much money you're going to need to survive this 12 months and what it looks like. You're going to need to run it weekly. And we say meeting your obligations because we all have to work together. So you will need to honor various obligations, not least to your staff, to the best extent you can. I think that's the sort of key initial point. The next thing is if you have any banking covenants, if you do, and you don't think you can satisfy these covenants, you need to start talking to your bank. Banks hate surprises. The preliminary advice is that banks will be cooperative, are being asked to be cooperative. Obviously, the government's bringing in measures, but they're still banks, they're still businesses. A circular problem which may affect some of you is some of you may be required to deliver audited accounts to a strict deadline. Again, you need to talk to your bank because for an auditors, as we are, it's very difficult to sign off a set of accounts with an audit certificate of 12 months, which is one of the key things for a clean audit report, the going concern principle as it's known. At the moment, it'd be very hard for us to do. So having gone through previous crises, it's a sort of bit of a chicken and egg, but if that's a requirement, you've got to talk to your bank. And certainly we would be willing to prepare those accounts to get them finished effectively, but not sign the audit report. And once you can agree your liquidity with the bank, we can then sign the audit report. It's a bit of a chicken and an egg. I think the point is that the banks, aren't the government and the government aren't the banks. So the government's going to support the banks. But yeah, as I say, these are independent businesses and they will need something that makes sense. They will need a cash flow. They will need a plan as to, what are you doing if you want to raise debt from them. This is, again, another sort of the same point is that don't borrow in a rush. You're going to have to pay this money back or go bust, really. So you've got to work out a plan where you can pay this money back. Don't do it in a rush. Only do it if you really believe it will make you survive. The cash flow shows it. As much as anything else, you've got to remember your other creditors as well, in terms of doing things now which disadvantage some of your creditors. That won't be seen very well if you do go bust and you'll end up in insolvency with an insolvency practitioner looking at some of the decisions you made. That wouldn't be such a favorable place to be. So don't borrow in a rush, but do start talking to your bank now. I'm going to hand over to my dear friend Hugh to do number 2.
Thank you. So good afternoon, everybody. Obviously, what Andy's been talking about so far is debt, and all of those warnings that he's delivered there are important to take account of. So one of the things that we thought we'd have a look at here is just the other opportunities to raise cash in a relatively sort of efficient and quick way. So on the next slide, we talk about the R&D tax credit. Some of you may be claiming that already, some of you may be considering it, and some of you may not do any. So just to clarify, I mean, R&D, we're looking at any technological or scientific advance. That can be in terms of product, in terms of the services you provide. It could be your systems internally, processes, anything where you are delivering a technological or scientific advancement could potentially qualify for R&D. It's a generous relief if you're a small or medium enterprise. You could be looking to get up to 33% of what you're spending on R&D back. So it's a generous relief, and it's one that's just cash to you. You're effectively cashing in your tax losses for the future, but it's cash that belongs to you then. It doesn't need to be repaid. So it doesn't carry any of that risk associated with it when we're talking about debt that is available. So certainly explore that. If you are doing R&D at the moment and you have the opportunity to, one of the things that we can do is shorten your year end. So bring forward effectively the end of the current financial year, close that off, prepare accounts and a tax return. Submitting that, at the moment, HMRC are generally reviewing those claims and delivering the cash back to you within about 28 days. So give or take sort of 25 to 30 days, you should get cash in your bank account, which is there to support the business. Still a requirement that you are a going concern, but there's certainly an opportunity there if you have made claims previously to sort of accelerate those and bring forward that cash flow to the business. There are some caps on this, so state aid is something that's coming to the fore at the moment. If you've had more than 200 million euros of state aid, these are EU rules, so may be relaxed or maybe disregarded in some.
So it's £200,000 of state aid in the last 2 years, I believe.
Yeah, in the last 3 years, there is that cap on there. So if you have been claiming other grants from the EU, from the UK, or been claiming R&D, there can be restrictions on what you're doing. But it's worth exploring in any case and seeing what we can realise out of what you've already spent, and as I say, bringing forward some of those tax losses so that you've actually got cash to support you at this difficult time. The government obviously has announced a number of measures, and he's talked about the debt and more interest, but more information will come about that in the next week or so. It hasn't been announced exactly who is going to be administering it yet, so we'll update you as we go through, and that will be part of the weekly updates that we're running. There was an business interruption loan scheme that was announced in the budget. That's been extended, so businesses can get up to a £5 million facility with interest being covered by the government for the first 6 months. Now, obviously, that's great. It enables you to obtain that cash, but it carries all of those warnings that we've talked about. So just beware that if you're taking out that debt, you are able to demonstrate how that's going to be paid back. As I say, we'll update you more about how you can apply for that and the process for doing so as that becomes available. Another thing that was mentioned in the budget was a cancellation of or 100% discount on business rates for anybody in the leisure, retail or hospitality sector with a rateable value property up to 51,000. That's been extended now, so all retailers, all hospitality businesses and those in the leisure sector are going to receive that 100% discount on business rates now for the year. So that's very helpful, but doesn't apply to all businesses. The one that is available that there's been a bit of confusion about was a cash grant that's available. Announced in the budget is 3,000 and has been extended in the special measures to 10,000 for any small business that qualifies for the small business rates relief. It's going to be administered by the local authorities, so it is related to your business rates. It's not generally something that's going to be applied on payroll or anything like that. So disappointing for some, but certainly £10,000 is useful injection of cash. Again, it's a grant in relation to those that qualify.
Thanks, Hugh. And I think the issue on that is if you don't have premises, unfortunately at the moment these grants aren't, you can't have a way of accessing them. So obviously there's a lot of businesses distressed about that, but we're waiting for further information on that.
So yeah, I mean, talking about how you're going to get that money, as I say, we don't have much detail at the moment. The credit, the £10,000 credit is automatic and will be dealt with by the local authority. In terms of the loan, these are guaranteed up to 80% by the government, and as I say, more detail will follow and we'll provide that as we know it. We do want to just raise that warning here that 20% of the loan is not covered by the government, and so it is worth just bearing in mind that there may be some security that the bank will seek in order to actually grant that loan. Now, whether that is personal or whether it's a full asset review, we're not entirely sure. So it will depend on the circumstances of your business. But do just bear that in mind. That it isn't all 100% guaranteed. So there needs to be some expectation of being able to pay it back. Other things that the government has announced today, obviously the Bank of England has dropped the interest rate to 0.1%, so historic low, and Companies House have announced an extension deadline for filing of accounts. So that's the kind of thing we'll talk our clients through and make sure we're exploiting whatever is offered there for the good of the business.
You do have to ask for the extension.
Yeah.
Also, for VAT and paying tax, they are going to be lenient, but you do have to speak to the revenue in order to get that leniency. If you can't get through to them, they say that they won't penalise you as a result on interest and penalties. But effectively, if you don't think you can pay your PAYE, VAT, or corporation tax liabilities, you've got to get on that phone and try and agree a plan with them. This has always been the case. If you agree a plan with them, they're usually pretty draconian if you don't stick to the plan. So don't overpromise. You know, it's a real sort of under-promise, over-deliver kind of situation. Thanks, Hugh. That's great. Ross, on to redundancies, or avoiding redundancies, one would hope.
Yeah, thanks, Andy. I think the key here, you're going to have to look at your staff. You're going to have to look at which members of your staff are able to continue working, or is there enough work for them? Ultimately, this will probably lead to compulsory redundancies. I don't think there's any way around it in a lot of cases, but there are ways of avoiding them. And the key when you consider this is careful planning and clear communication with your staff when discussing alternatives to redundancy. So let's have a look at some short-term hacks. Just look at things like banning overtime. If you do offer overtime, look at banning it, restricting it. What you've just got to be careful about is that this is communicated with the employees, especially the ones that may rely on that additional pay that they receive from working overtime. I think in the current financial climate, they should understand. They should see why you have to do this. In terms of staff that you don't have any work for and you want to retain, look at requiring them to take holiday. So under the statute, that there are provisions where you can require them to take holiday. You have to give 2 days for every day of holiday for the employees. So the example here on the slide is for 5 days leave, you need to give 10 days notice. However, if you have contractual provisions that allows you to require them to take holiday at any time, that would override the statutory provision. So a lot of you will have contracts that we've prepared and they will contain those provisions. So you've got more of a right straight away to say to staff that we're going to require you to take holiday because there's no work for you. Another alternative on holidays is maybe asking them to take more holiday in return for a reduction in their salary. It's probably not that palatable in this climate, but there are options of paying for holiday where staff can see, well, I might as well take more holiday if it keeps me in my job. Then there's what I would call the more long-term alternatives. One option is, and all of these need the written agreement, the express written agreement of your employees. The first on the list is unpaid leave. So look at agreeing a period of unpaid leave with staff. You'll need them to, in writing, to confirm that they agree to the changes to the contract. The other one is permanent reductions, maybe in hours of work and salaries and other employee benefits. Again, you have to look at the contract. You would need the written agreement, but again, in a climate like this, I think staff would rather keep their jobs because there's not jobs out there. There's freezes on recruitment. So they should understand why you're having to approach them in this way. There's then the concept of layoffs and short-time working, known as LOST, layoff and short-time working. Now, this is in statute and was very popular in the 1970s, but it faded out in the 80s and 90s. It came back a little bit in recession, but it's not used in many industries. It's mainly used in the manufacturing sector. What you normally need to be able to do LOST is a clause in the contract that allows for this. Otherwise, you need, again, the employee's written agreement, which I think many of the people on this call will not have this in their contract. It's not very common. But let's have a look what layoff and short time means. Layoff means that you're going to provide them with no work and no pay for a period whilst retaining them as employees, whereas short time is where you say to them basically, we need to temporarily reduce your hours or days worked during a given week, and we're going to reduce your pay and to less than half as well at the same time. That is what short time is. That I see out there on the internet. So it looks like this might be an option that employees would be interested in. You're just going to be aware that they could claim guarantee payments. Now, the current maximum is £29 per day for 5 days in any 3-month period. So that's £145. So it's not a lot of money. That's not really an issue. The issue that you could find is that employees resign and try to claim a statutory redundancy payment. This would apply to people who have 2 years or more continuous service. Now, they would be able to resign and try and claim a statutory redundancy payment if they've been on lost for at least 4 consecutive weeks or a total of 6 weeks in any period of 13 weeks. I mean, you do have the right to counter notice and argue that actually you're going to be able to bring them back to full time, but it's just something to bear in mind that this could prove quite costly if you're dealing with employees with long service. Another option is volunteers for redundancy, where you ask people to volunteer and in return you offer a voluntary redundancy package. The problem with this is that you will have to pay out, so it's not a cost saving as such, but what it does avoid is the requirement to carry out compulsory redundancies and follow a fair redundancy procedure. What you would need to do is enter into a settlement agreement with the volunteers just to ensure that they're waiving their rights to bring claims against you, and the employees would be entitled to receive independent legal advice. Ultimately, and probably unavoidable, is that you're going to have to carry out some compulsory redundancies. It's tough, and it's real, as it says on this slide. Hopefully you'll survive the storm and you'll be able to hire them back. Well, at least the good ones anyway. Now, what you need to do is carefully plan. Depending on certain circumstances, will work out what process you need to follow in a redundancy. So let's have a look at some of those considerations. I think first of all, if we start off with looking at what the definition of redundancy is, and redundancy can be a workplace closure or where there's a reduction in the requirement for an employer or employees to carry out work of a particular kind. So it makes complete sense here. What you have to do in a redundancy process is follow a formal process. Failure to do so could lead to claims for unfair dismissal, wrongful dismissal, holiday pay, and discrimination claims. Now, to work out what formal process you have to follow, there's a number of questions you've got to ask yourself. The first one is, well, how many staff are going to be affected by this? If 20 or more staff are at risk of redundancy, as well as individual consultation, you've got to follow collective consultation. Failure to do so could lead to criminal sanctions against the directors, and also affected employees can claim up to 90 days gross pay. So it could prove quite expensive, and also the criminal sanctions. If you've only got 19 or less staff at risk of redundancy, then you just have to follow an individual consultation process. Another thing to ask yourself is, well, let's have a look at the staff that are at risk. What is the length of service? If it's less than 2 years, they don't have the right to claim unfair dismissal. So the process in those circumstances may be a lot more straightforward. If it's more than 2, they do have the right to claim unfair dismissal, and you do need to ensure that a full formal process is followed. Another question is whether all employees are at risk of redundancy or only a few. If all employees are at risk of redundancy, then the formal the formal process should be fairly straightforward, subject to having to follow collective redundancy obligations if you've got 20 or more staff at risk. If not, if it's just a number of those employees, you need to ensure that the selection process and consultation process is fair and objective. Where you have not all your employees at risk, you should ask yourself a question for each of those employees. Do they carry out a unique role in their business? Is their role not similar to anyone else's, not the same? If it is a unique role, then again, the process could be a lot more straightforward. What you will need to consider is the concept of bumping. And what this basically means is You may be removing a senior manager role from the organization. That senior manager has higher skill sets than people in more junior roles that he could fulfill and he could fulfill those roles. He may request, or you may consider that you'd rather save him and retain him by bumping out a more junior employee. It doesn't mean that you have to keep him on the same salary, him or her on the same salary. They would have to be paid the salary of the junior role, but it's an option that may help you retain higher skilled staff, particularly when there's no jobs on the market. If you have a number of employees carrying out the same role, and you look, and for example, only one of them is at risk, you would need to pool all those employees. And what you'd need to consider is fair and objective criteria. And the common criteria that people use to score people, to work out who gets the lowest score and then is the person made redundant, are such things as attendance records, disciplinary records, skills or experience, and performance and standard of work. There can be situations where, say, for example, you've got 4 or 5 staff carrying out the same role. You only want to remove one member of staff, but when you've done the scoring, 2 members of staff have scored exactly the same. What do you do in those circumstances? Well, there is a concept of last in, first out. So the person that has been with the company for a longer period should be kept, and the person who's been there for a shorter period would be the person who's made redundant. The key to this formal process is consulting, having a clear communication and consulting with the employees. If it's collective redundancies, there are set rules to follow, which involves appointing employee representatives and consulting for a certain set period. If it's between 20 to 99 employees, it's for at least 30 days. If it's 100 or more, it's 45 days. If it's less than 20, all you need to consider is individual consultation. And the things you need to discuss with those employees when you're going through an individual consultation process is listed on the slide, and they include explaining why you're planning on making the redundancies and allowing the employees to discuss and consult with you over ways they think these redundancies could be avoided, how to reduce their impact, and also ask the question of why have I been selected for redundancy? What you need to do during this consultation process is consider and respond to the suggestions that they've made. It doesn't mean that you've got to accept what they say. You can reject any ideas that you don't think are reasonable, but you'll need to explain why. And a key thing for this process is that you document all discussions and the reasons for your decisions. Another thing to consider before you work out what the process is that you follow is also, well, what are the redundancy entitlements for each employee? And what they're due as follows: that they're entitled to their salary and contractual entitlements up to the termination date. This will be fully taxable. They're also entitled to any accrued but untaken holiday, and this will also be taxable. They're entitled to the notice pay, and you could require them to work their notice, or you could decide to pay them in lieu of the notice. In both instances, this would all be fully taxable. Now, if the employee has 2 years or more continuous employment, those employees with over 2 years would be entitled to a statutory redundancy payment. And it's based on a formula, based on their age, the number of 4 years service, and their gross weekly pay. The gross weekly pay is currently capped at £525 a week. It is increasing to £538 from the 6th of April. And then the other considerations is what other things are they entitled to, or do you need to deal with on termination? And that they could include bonus or commission payments if they're owing, and also what happens to their share options if they're entitled to share options.
I think when we discussed this morning, Ross, too, we noted, you know, with redundancy, a lot of it is consulting, but giving reasons why. Obviously, we all have quite a clear reason why at the moment, and the sense we're getting from clients and people is that employees are very understandable. And indeed, if someone hasn't been there for 2 years, you may need really very minimal process. Would you agree with that?
Yes, I do. I think in these circumstances, you can have a more straightforward process with people with less than 2 years. That they may be the first people you look at, whether you need to retain them, because the process to follow and what they're entitled to and the potential claims are minimal risk.
Thanks, Ross. Back to you, Hugh, on our most favourite concept, insurance. But there is something that is perhaps worth mentioning.
Yeah, so I mean, a couple of things. Staff insurance, make sure you do have your employer's liability insurance and make sure it does cover people if they're working from home and away from the office. One of the, some of the government announcements have made a very big thing out of the interruption insurance or business disruption insurance still being effective. Given the announcements they've made. So if you have that kind of insurance, look to the insurers to establish whether or not they will cover you for some of that business disruption that you're experiencing. The insurance market is still open, and we've very much got that message. One of the key things that we've been looking at here, and it focuses the mind when something like this happens, is looking at key person insurance. So key directors, owners of the business, that, you know, the people that are going to worry and stay awake at night trying to make sure that the staff are paid. You know, how do you cover them for incapacity? How do you make sure that the business is able to sustain for a period of time meeting its obligations if they were taken out of the business? And as I say, that's something that particularly at the moment is kind of central of people's minds. The insurance market is open for it, and it may be something that you want to consider even at this stage. And then looking then at the ownership protection, if we're talking about partnerships, LLPs, actually having that insurance in place. See at the bottom, it's a tax efficient way of doing it. This is a deductible expense, but it's ensuring then that there is a process and an agreement in place for how that business is to continue if one of the key people is taken out. So yeah, definitely worth still considering insurance, even though for most people it seems off the agenda at the moment.
And I'd just add that if anyone is worried about family members and so forth, that you do get a power of attorney, an enduring power of attorney in place. If you Google it, you'll come up with the government's website. You need to register it with the government. It's a bit of form filling, but it means that if someone becomes unable or incapacitated, you can make decisions, you can access the bank account, you know, and even simple things like you may want to get loved ones to write their, you know, passwords down, perhaps if there's, you know, a place with all the photographs. But definitely a power of attorney between, you know, key loved ones is definitely a key thing to suggest. Moving on now to force majeure, which I'm sure, like you, has been something in contracts you've stared at many times, and now it applies. Simon, over to you.
Thanks, Andy, and good afternoon or good morning, everyone. Yeah, Andy's right. Force majeure is one of those clauses that sometimes appears in a commercial contract, and in most cases, people just gloss over it. And really, one of the reasons why we're going to talk about this today is that if you're having difficulty, or if you think you might have difficulty performing contractual obligations that you have, or indeed if you're a party to a contract and you think the other party might have difficulty in performing contractual obligations, then it's worth having a look at the force majeure provisions in your commercial contracts to see whether they either provide you with a way out of the contract, or whether they allow you to pause the obligations under the contract for a period of time. Under common law jurisdictions, i.e. England, Wales, Australia, New Zealand, US, Canada, force majeure clauses are quite common, but you do come across some commercial contracts that don't have them. And I'll talk a little bit at the end about what you might do under those circumstances. But what we're encouraging all of our clients to do, if they are concerned about whether they're able to meet their contractual obligations, is to firstly have a look to see whether the contract has a force majeure provision in it. Look to see what the circumstances are giving rise to force majeure. Often you'll see things like acts of war, strikes, natural disaster in those clauses. It's not that common to see any reference to epidemics or pandemics, but sometimes, even if there's no specific reference to an epidemic or a pandemic, sometimes those clauses will have reference to government action. And certainly if there were to be a complete lockdown that prohibited people moving around, if they needed to perform their contractual obligations, then that would likely be considered or caught by that kind of catch-all of government action. So really what our advice to our clients is take stock of your contracts, have a look to see what impact you think COVID-19 will have on your ability to perform those contracts, and develop a plan, a mitigation plan. And it's important to point out that under a force majeure provision, even though they exist in contracts, generally, if it becomes more expensive for you to perform your contractual obligations, or it becomes harder for you to perform your contractual obligations, you can't necessarily rely on force majeure to get out of that contract. But what we just suggest to everyone is take a look at the provisions, work out what your action plan is likely to be, and then have a conversation with the other party to the contract. I think the really important thing for everyone to remember at the moment is that everyone is in exactly the same situation. So if you've got two contracting parties in the same jurisdiction, or even if they're in different jurisdictions, then it would be sensible to work out what an action plan is and have a conversation with the other party about that. As with most things, all contracts are subject to negotiation, and certainly in these early days, it would be much better for you to develop an action plan now and start to talk about the other party around what you propose to do to mitigate any risks or under that contract, to do that now rather than at a point in time in the future where you start missing your obligations. And where you need to be particularly careful in a commercial contract is if there is any reference to time being of the essence in the delivery of certain aspects of a contract. So for example, if there's a clause that says time is of an essence to do A, B, or C, and you miss that deadline for A, B, or C, then technically you could be in breach of contract, even if that you missing that deadline arose as a result of COVID-19. So very practical advice at the moment is take stock of your contracts, work out what impact COVID-19 might have on your ability to perform, and then start talking to the other side as soon as you've got an action plan in place. Similarly, if you have a contract with a counterparty and you're concerned about that counterparty's ability to perform that contract, and if they've not made any contact with you, then we would also recommend to our clients to actually contact the counterparty and ask them whether they're in a position to talk to you about whether they're going to be able to meet their contractual obligations, and if not, what their action plan is. So don't just wait for the other side if you're concerned about obligations. If you happen to be involved in contracts that are effectively a chain of contracts, i.e. you might be reliant on goods being produced somewhere else in the world to come to the UK to then go to a client here, you need to make sure that you're looking at your whole contractual chain to work out how you might deal with failure points in the contracting chain. A couple of other bits of advice is that where you have strategic meetings internally or at a board level, and you're talking about your mitigation plans in relation to contractual performance, just make sure that you're keeping an accurate note of those discussions. Just jot them down, or if they're board if it's a formal board meeting, just make sure they appear in the minute, because if ever you do get into a situation down the track where there is some contractual dispute, if you can produce evidence of the steps that you took at the time that you took those steps, and that might help you in if you're ever subject to any litigation around this sort of stuff. Practical point is that even though we're all faced with this highly unusual situation, business is going on, and companies are continuing to negotiate contracts. Our advice at the moment is that if you are negotiating contracts, or even if you're at the very end and you're about to sign contracts, just take stock of whether there are appropriate provisions in the force majeure section of the contract to deal with this sort of pandemic if it continues for a long period of time. And as we said, and as everyone knows, it's very, very uncertain about the duration of COVID-19 anyway. So don't stop doing business, but just make sure that you're super cognizant of the need to pay more attention to certainly the force majeure clause than you may ever have paid in the past. A couple of other things as well is that you might want to consider whether your commercial insurance covers the situation that we're currently faced with. And often if you're going to try and rely on your insurers will require you to enter into some dialogue with them. So we'd encourage all of our clients, if they are concerned, to take a look at their insurance policies, particularly things like professional indemnity insurance, and just make sure that you're on top of what the insurer's requirements are if they ever needed to pay out on those insurances. You'll recall at the very beginning of my section, I spoke about contracts that don't have a force majeure clause in them. If your contract doesn't have a force majeure clause in it, and there are many around that don't, you might also be able to rely on what's known as the common law doctrine of frustration. Frustration is a very, very narrow interpretation, if you like, of force majeure, and effectively you could rely on it if a contract has become physically impossible to perform. Probably one of the simplest ways to think of this is that if you have a contract that requires your employees to go into a data center to pick up backup tapes, for example, and those employees A, can't get to that data center, or B, can't enter that data center because it's closed to any outside people to pick up those tapes, then that would be an example of a situation where you might be able to rely on frustration if you haven't met that contractual obligation. So worth keeping that in mind. And as you'll see at the end of the presentation, we're here. You can ask any questions now, and we're certainly around later on or some point a little bit further down the track. And now just the last point, and I think this is a point that is on the minds of most anyone who is the director of a limited liability company in the UK, and we're increasingly getting questions asked of us about when do directors become personally liable if they're the director of a limited liability company. And I think it's important to remember that under normal trading conditions, directors of UK or English registered companies, they have a whole bunch of statutory duties that are all set out in the Companies Act, and essentially those duties are around promoting doing things in the best interest of the company, and doing those things with reasonable care, skill and diligence. And the very nature of limited liability companies affords a high degree of protection to directors for English registered companies. Where, though, you do need to be very careful is where the company is in a position where I don't know what's happened to the screen, but anyway, you need to be careful where if the company is in a position where it might be heading towards insolvency, because at that point, the obligations of a director shift from being to act in the best interest of the company to act in the best interest of the creditors of the company. So there is a very fine line, and this comes back to the very first point in the presentation, where it is key for everyone to be doing cash flows and then updating those cash flows on a regular basis to make sure that you're not heading towards a situation where you might be trading insolvently. And that's where the pendulum shifts with respect to director's liability, because if a director trades wrongfully, and that requires the director to have knowledge that the company didn't have enough cash to continue trading, then an insolvency practitioner could in fact come after the directors for a personal contribution. So it is this is why remaining on top of your cash flow is absolutely critical at this particular point in time. And I guess just some practical tips in that respect is, as Andy said at the beginning, it's really important that all of the directors of the company keep in regular contact with one another. You should seek professional advice as and when, or even before you think things might be sliding to kind of, the very extremities of survival. And you should ensure that the CFOs in your organization are absolutely on top of cash flows and financial data. Andy mentioned in his slides about watching your banking covenants. If you happen to have investment from venture capitalists or PE money, it is highly likely that your investment agreements will have certain performance-related covenants. So not only if you've loaned money from the bank where you have obligations to the bank, but I expect if you've got VC or PE money, you'll have obligations to your VCs or PEs. And once again, we'd encourage you to take a look at those covenants, work out whether you are going to be able to meet those covenants, and before you breach them, open up dialogue with your venture capital partners. So so that's the final bit of advice from me, and now I'll hand back to Andy.
Thanks, Simon. And yeah, as it says in that last line, one of the main things you need to do is just if you're worrying about it, is call a directors meeting, do your cash flow. So that's it. Good luck, everyone. I guess we're going to do some question and answers. There should be a button at the top if you want to ask a question. Chuck it in there. We'll go through them now. A last comment I would make is there are going to be a lot of opportunities. If you can sort your liquidity out and stay calm, don't get so stressed you're missing, a really, fantastic opportunity. If I can give you an example, a lot of businesses that we deal with, obviously their values have been severely affected, certainly temporarily affected over the next 12 months. Now, if you're a tax person, that's quite good to know sometimes, because it might prevent opportunities in regard to moving assets or flipping structures between countries, Australia to the UK, or because the value of the business decreased. Share options, you may be able to issue unapproved share options to non-exec directors, which was going to cause a lot of tax issues before, but perhaps not now. So keep an open mind, because there's things to be done that could be quite opportunistic in this situation. If for some reason I'm going to stop sharing to try and bring the questions up. Here they are. Very good. Okay, thanks for the questions. So the first one, Robert, small business government grants. Do you have to be a business rates payer to obtain the £10,000 grant? Yes, that is unfortunately the current situation. If so, what is available to businesses that work from home or facilities such as WeWork? Unfortunately, and I've had some quite upset clients about this today, understandably, considering a lot of people were encouraged to do co-working. At the moment, there's no grants for you if you're co-working or working from home. I think they've slightly gone on the basis that, if you've got a property or you're a florist or something like that, that they'll they'll help you out. If you're working from home, you know, you can claim benefits, you know, the dole and such not. I guess, you know, it's certainly terrible for the creative industries who almost, you know, entirely work from home. So at the moment, we're waiting for more information. There's obviously going to be these loans coming through next week. The loans, you know, as we say, we don't want to rush to take one, but 0% interest. If we can put together a cash flow that works, that's going to be the way to go. But let's see if they get a little bit more helpful. There's a question, unfortunately not connected. Is this political? Is this applicable for companies regardless of size? You must have been asking it during the thing. What if the newer employees score better than those who have only worked here for a year? Additionally, the one most at risk is recovering from an operation. Ross, what if the newer employees score better than those who have only worked here for a year? Additionally, the ones at risk is off sick, recovering from an operation.
Well, the good news is they've all got less than 2 years employment, so there's no unfair dismissal risk. It's just that there's other claims they could bring, discrimination, but if you can justify it based on results that the new employees, maybe they've got a better pipeline and the like, I don't think you can go too far wrong. In terms of the sick employee who's part of that, you need to get in contact with that person, irrespective of, you know, the redundancy sort of overrides the sickness. You know, if you had someone on maternity leave and there was a redundancy situation, you've got to include them in the process. So you would need to get in touch with that employee.
Thanks. I'm wondering what options there are on holding off from HMRC payments. As we say, you've got to contact HMRC and agree a payment plan with them. Don't agree a payment plan you can't stick to, because traditionally if you break the rules or if you break your own payment plan, they consider you effectively a liar and come at you. I don't think that they're going to be doing that. They have said they're not going to be chasing interest and penalties. Time for pay is the concept. So for VAT, PAYE, all these things. But you know, ultimately you've got to agree something with them. They'll give you time, but it's you can't create a sort of false economy too much of hoping you can avoid all these liabilities forever. You've got to make a plan that makes sense for it. The work questions around working from home. Obviously, a lot of staff have now moved home, and people asking, you know, what are the provisions for that? We're looking at this quite closely, whether or not there's something a little more innovative we could do on using some of temporary workplace reliefs. But at the moment, you will be shocked to learn that £6 a day is the amount that you can pay an employee from working from home with that as a standard amount, as an amount that's a sort of flat allowance that you can give. It used to be £4 a day. There is quite a lot of chat and upset about this. I think you could look at them paying a proportion to them, you know, to cover their sort of home costs. And we're going to update something on this and have something a bit clearer on that next week. Another question is in regard to raising money in this current situation. Obviously, that's it's extremely difficult for some businesses. Now, if you're not aware of them, there's something called SAFE from America, which is a simple agreement for equity, or an ASA, advanced subscription agreement, I think is the British term for it. They are peculiar in the fact that they still allow an EIS investment to follow. So if you're aware of this very generous tax relief, EIS, SEIS, right now setting the valuation of your business is obviously rather problematic. So if you're looking to raise capital, an ASA agreement would be quite a sensible route. They effectively, it's an agreement that you will issue them equity at a future date once you do a raise and establish an evaluation point. Now, the Revenue have issued guidance back in, I think, January, saying they didn't want these longer than 6 months. But that's just guidance. We've been in touch today with the leading advisors in the country on EIS, who are lobbying HMRC heavily on this matter to ensure that they are going to be reasonable and allow a 12-month period. So you can write an agreement today to say, I don't know what the valuation is, but could we have some cash when everything's back online in 9 months? We're going to do this raise. and we'll issue the equity then. And they are very popular agreements, particularly popular in America. Carly, how you doing? Andy, in your experience, do you anticipate any delay in HMRC's processing of R&D tax credits, considering the current circumstances, assuming many business would potentially rely on this cash flow? So you may be aware that last year, the HMRC got themselves in an absolute muddle, and they have a 28-day rule. They're supposed to pay you cash or raise an inquiry in 28 days. They got completely lost on it, and it was a mess. They've reorganized themselves, and now what's happening is if you don't get pinged, which is based on various criteria, I'd say about 1 in 10 chance, it should go through. You should have the money in 28 days. It will probably be some of the fastest ways to get money. If you get pinged for an audit, I can tell you, because I've got, some that are going, you can't even get a letter from the revenue. It took 4.5 months to us to get a letter, which we replied to the same day. And I'm 2 months later trying to now get a reply to that. So, we understand there needs to be inquiries, but it is not great if you're going into inquiry. My sense from the politics is they'll just have to start saying, go, as in pushing out the money and not be so draconian on some of the inquiry points. Ian, how you doing? Rather than cash flow support, we'd like the loan as growth capital. Maybe cynical, but presume now is a good time to draw that. But do the same government backing rules apply? Rather than cash flow support, we'd like a loan as growth capital. Effectively, you're dealing with a bank, Ian. So we've got to go to the bank with a plan. I have a few clients who are scrapping going to venture capital and going to go apply for these loans because you can get up to 5 million interest free for 6 months. Sounds good. We need, if you can put a plan together that the bank can accept is a sensible plan, I think it is a very logical step at the moment, as it were. Let me take a look and make sure we've answered those questions. I think the other things that came up this morning, was there anything else, gentlemen, that was worth raising? I'm just trying to recall the further question that came in. Yeah, I think we'll update weekly. We're here trying to give you some information in the madness, as it were. And let me just have a look in regard to the sort of employee matters. As Roscoe and as Ross was explaining, they're obviously complex, but there's a lot of understanding at the moment. This presentation is being recorded, so we are looking to release the recording, so you've got it. Now, some of the presentation was obviously quite detailed, but that's so we can give it to you, and you've got a sort of guide to help you through, as it were. But if there's no further questions at the moment, I think there were some questions that came before the meeting, so I'll just check we've answered those. But I just hope you're all right, and let us know if we can help. Let us know what was missing in this. If there's other things you want to look at, and we're here to help as best we can. So thanks, Ross, Simon, Hugh. Thank you.
Thanks, Anya. There's just one more question. There's whether the slide deck's available, but we're emailing it, are we not?
Yes, the deck
yeah.
will to everyone, of course, in due course. Thanks for everyone's time, and hope you go well. Let's go see what Boris has got to say at 5 o'clock, I guess. Thank you both. Bye.
Right. Thanks everyone. Bye.